Imagine you open your brokerage app on a random Tuesday morning. You're just killing 5 minutes before a meeting, and there's a number on the screen you've never seen before, $750,000. And you sit there for a second, heart beating a little faster than you expected. Not because you can spend it, not because you're done, but because something in your brain recognizes, almost instinctively, that you've crossed into completely different territory. That something fundamental about your financial life just shifted. My name is Nico, and today we're going to break down exactly what happens after your invested portfolio crosses $750,000, and why this particular number is a threshold where the rules of personal finance change completely. Not because of what you can buy with it, but because of what it does mathematically, psychologically, and long-term, without you doing anything at all. If that kind of deep dive money content speaks to you, subscribe and leave a thumbs up. It genuinely helps more people find these videos, and we put a lot into making them. Now, before we get into the mechanics of this, I want to give you a few numbers to frame the conversation. According to Vanguard's How America Saves report, the median 401k balance for someone in their late 30s sits somewhere between $40,000 and $100,000. Empower's 2024 data puts the average American net worth at 35 around $136,000, and that includes home equity, cars, and everything else. So $750,000 in pure invested assets? That's not rich by the media's definition. You're not buying a yacht, but you're in a category that a startlingly small percentage of Americans ever reach before their mid-50s, if they reach it at all. Understanding what lies on the other side of this threshold is one of the most important things you can learn about how wealth actually compounds over a lifetime. Let me tell you about two guys named Kyle and Derek, both 35, both earning $88,000 a year. Both grew up in the same city, went to comparable schools, and work in similar industries. From the outside, they look like two versions of the same story. But here's where their paths quietly diverged. Kyle started putting $400 a month into index funds at 22. Not because he was some prodigy, he wasn't. He read one book, ran one calculation, and got a little scared about what waiting would cost him. He drove reliable used cars through his 20s. He and his wife stayed in a modest apartment a little longer than their friends thought made sense. He got teased at dinner parties for being boring with money. People assumed he wasn't living his best life. And now, at 35, Kyle has $750,000 invested. Derek took a different path. Every raise was a permission slip. The promotion at 24 became a $680 a month truck payment on a 6-year note. The raise at 28 turned into a kitchen renovation and a trip to Europe that he's still kind of paying off. His life looks great. His social media looks great. His portfolio has $120,000 in it. Now here's where it gets really interesting. Both Kyle and Derek have 30 years until traditional retirement. Both plan to keep contributing around $10,000 a year going forward. Same income, same time horizon, same future discipline, but watch what the math does to those two starting points. Derek's $120,000 growing at 7% average annual return, which is a conservative historical estimate for a diversified stock portfolio, becomes roughly $913,000 in 30 years just from the base amount. With contributions added in, he ends up around $1.86 million at 65. And honestly, that's more than most Americans retire with. That's not a bad outcome. But Kyle's $750,000 at that same 7%, without adding a single additional dollar, becomes $5.7 million. Add his ongoing contributions and he lands near $6.65 million at retirement. Same income, same future effort, but a $4.8 million difference, created entirely by choices both of them made before they turned 35. And that's the crazy part. Most people look at Kyle and Derek at 35 and see a $630,000 gap and think, okay, one got a head start, but they'll close it eventually. But they won't, because compounding doesn't close gaps, it widens them. Time is not neutral. It aggressively and ruthlessly favors whoever has more money sitting in the market earlier. That's not an opinion. That's arithmetic. Let me show you the math that genuinely reframes how all of this works. $750,000 at 7% annual return generates $52,500 in portfolio growth in a single year, just sitting there. No new contributions, no effort from you. Now, Put that in context. The IRS contribution limit for a 401k in 2025 is $23,500. Add a Roth IRA, and you're looking at a maximum of around $30,500 in annual contributions from your paycheck. So at $750,000, your portfolio is already generating more in annual growth than you could physically put into every tax advantage account the IRS allows combined. Your money is out earning your own ability to contribute. That is a crossover point. And that is the exact moment the rules change. Before the crossover, you are the engine. Your income, your savings rate, your discipline. All of it is what moves the needle. Every raise matters. Every month you resist lifestyle inflation matters. The math responds directly and personally to your behavior. But after the crossover, the market becomes your co-pilot. Even in a year where life happens, a layoff, a medical expense, a season where contributions just aren't possible, so your portfolio is still doing the heavy lifting without you. You've built momentum that no longer requires your constant input. And there's another way to think about this number. $750,000 at the 4% safe withdrawal rate, the guideline many financial planners use for sustainable retirement drawdowns, generates $30,000 a year in passive income. Not enough to retire on a loan for most people, but enough to fundamentally change how you think about risk, career decisions, and time. That's real financial breathing room. And that psychological shift is something the research keeps pointing to. People who accumulate this level of invested wealth report significantly lower financial anxiety, more confidence in career decisions, and a different relationship with risk. Not because they become reckless, but because they have options. The fear of losing a job doesn't hit the same way when your portfolio is generating $52,000 a year in the background. You don't panic during a market correction the same way you did when you had $50,000 at stake. You've moved from fear-based financial decisions to strength-based ones. And that transition doesn't happen at $100,000. It doesn't fully crystallize at $300,000. It happens somewhere around here when the math shifts underneath you and you can feel it. But here's the part that keeps most people from ever reaching this threshold. And I want to be direct about it because it's not about income and it's not about luck. It's about what happens to money in the decade before the crossover. And the financial industry is extraordinarily good at capturing it before it ever compounds. Think about the car payment. The average new car payment in the US right now is over $730 a month, a number that has never been higher in American history. And the industry has gotten incredibly skilled at making that feel not just normal, but practically responsible. It's just a monthly payment. You need reliable transportation. The rate is low, so why not finance? But $730 a month invested instead of paid to a lender, starting at age 25, over just 10 years, becomes roughly $127,000 at 7%. Leave that alone for 30 more years and that single monthly decision compounds into nearly $1 million in alternative outcomes. One car, one payment that most people sign without blinking and never think about again. The same logic extends to every form of lifestyle inflation. Every time someone gets a raise and immediately upgrades their apartment, their wardrobe, their travel, their weekend habits, they're not just spending the raise, they're spending the compounded version of it. A $10,000 annual raise that gets absorbed into a nicer lifestyle instead of invested over 25 years at 7% represents closer to $54,000 in real long-term wealth lost, month after month, raise after raise. And it never feels that way in the moment because each individual decision seems completely reasonable and honestly well-deserved. That's the trap. Individually rational decisions producing collectively devastating outcomes. Now let me speak to the objections I know are already forming because they're fair and they deserve real answers. First, what about market crashes? $750,000 can become $500,000 very quickly when things go sideways, and you know that. 2008 was real. 2020 was real. Real people watched portfolios drop 30%, 40% on paper and made the worst possible decision. They sold. They locked in losses right before the recovery came roaring back. But the people who built $750,000 through consistent, boring, decade-long investing have already been through volatility cycles. They have the emotional track record to hold. And historically, without a single exception in over a century of data, every major market crash has been followed by full recovery and new highs. The drop from $750,000 to $550,000 is psychologically brutal. But for someone with a 25 to 30-year runway, the math still wins. You have to give it room to work. Second objection, and honestly the one I hear most: I'll never get there. I started too late. I don't make enough. I want to push back on this specifically. $750,000 in invested assets is not reserved for six-figure earners. Someone making $65,000 a year who consistently invests $1,100 a month for 20 years, starting at 30, lands around $600,000, within striking distance of the threshold. A few extra years or a slightly higher savings rate and they're through it. The number is more accessible than it feels right now, but only if you stop letting every raise disappear into lifestyle expansion before the investment account sees a dollar of it. Here's the opportunity cost payoff I want to leave you with, because the math is brutal and I think it deserves to land fully. Derek is 35 with $120,000. Kyle is 35 with $750,000. The difference between them, that $630,000 gap, left to compound for 30 years at 7%, represents $4.8 million in divergent futures. $4.8 million. Not because Derek made catastrophic decisions. He didn't lose everything in a bad investment. He didn't blow it all at a casino. He just signed car loans, upgraded his apartment a little early, spent his raises before they could sit still and grow, and repeated that cycle for 10 years. Decisions that were socially normal, even celebrated by everyone around him. And the cost of those totally ordinary choices is $4.8 million in wealth that will never exist for him. That is what the $750,000 threshold is really about. It's not a milestone for bragging rights. It's mathematical proof that the system works, that time and consistency actually do what every finance book tells you they'll do. It's the moment your future stops being abstract and starts feeling real. When you stop asking yourself, will I be okay when I'm old? And start asking, what do I actually want to build from here? The people who reach this number, and I want you to be one of them, aren't the smartest people in the room. They're not all earning enormous salaries. They're the ones who decided early that letting money sit still and compound quietly was worth more than every status purchase they could have made with it instead. They became a different kind of person. Not flashier, not louder, just calmer, more patient, more capable of waiting, because they've watched waiting turn $400 a month into $750,000, and they know what patience actually does at scale. The financial anxiety that most people carry quietly for decades, it stops being the dominant sound in their lives. You don't need to be at $750,000 today. You just need to understand what's waiting on the other side of it. And more importantly, understand what's leaving the table every single month that you don't move consistently toward it. If this video gave you a new way of thinking about the math, drop a comment below. I genuinely read them and I want to know what landed. Share it with someone who needs to hear this. And if you're not subscribed yet, now's a great time. We go this deep on money every single week. As always, nothing in this video is personalized financial advice. Please work with a qualified financial professional for your specific situation. I'll see you in the next one.